Unemployment Friday for this highlight. It's important to understand patterns. Head fakes we talk a lot about, but long down up bar. It's not, doesn't matter what you think. It matters what you see. There's a saying, don't trade what you think, trade what you see. Journal what you think, write down what you think, record, document what you think before and after, and maybe even during your document, but trade what you see and don't be so stubborn that you had an opinion and God forbid you're wrong. That's exactly what happened in here. About 10 minutes after the open, it was bearish. It was bearish because we rallied 10 points or so after a slightly strong unemployment report, but we take back that entire rally, which started right here. It wasn't that bullish of a number. So it goes up, takes it all back. Yeah, it created some weakness, and I thought it was going to stay even a little bit weaker. And it's okay. What's not okay is to keep that opinion. So right in here, you get a long down up bar where the market moves lower and then it comes right back and totally retraces it. So let me put it out here. That's a down bar because these are rotational bars we're looking at. Remember that. So if this is a down bar, candle, however you have it made up, and the very next bar takes back the entire selling or the entire sell-off of it, then you got to question your bearish opinion. And you often get the next right side of the market to be up. And so that entire analysis is done in real time instead of still being bearish and the damn thing is up in here. And another thing I said is that if you're surprised that you're wrong, you're going to have big losers. You cannot be surprised when you're wrong. What happens is when you're surprised if you're wrong, you're not going to admit that you're wrong. So if you're bearish in or short in there and you're like, man, I'm surprised I was wrong, you still got this damn thing. And it's 9-10 points against you. And now it becomes a disaster. So you have to do what you say. But a lot of people don't even have their risk managed before the trade. If you're not managing your risk before you take the risk, you're going to be in trouble. You've got to manage your risk before you take it, which means know where you're going to get out for a loser before you get in. Everybody just thinks about the upside, the target for a profit. And I'll tell you a quick story. A lot of times being in this business for as long as I have, when you go out and people ask you what you do and you're at a party or something, and you tell them you trade commodities, they right away say, well, what stocks do you like? Or I like this stock, they say. And then sometimes I'll ask when they say that they have a stock that they like and they bought it. A lot of people like to tell you everything they bought. What'd you buy at $5? And it's supposed to go to 20. It's supposed to go to 30, going to go to 10. You'll hear those stories. I'm sure you guys have heard those stories. But you ask that person, well, what if it doesn't go to 20 or 50 or even 10? Where are you getting out for a loser? And they don't have an answer because they don't have a plan to get out for a loser. They're getting out at 0.00. That's where they're getting out. They're going to risk the entire, their entire investment. As traders, we're not risking our entire investment, our entire account. Or forget even about risking 1 or 2%, that nonsense. Because 1 or 2% is just the scientific value of your account. That doesn't connect with your emotional disposition. Risk aversion, if you take more risk better than other people, it's all about your emotional capital. That's the 1 or 2%. And that 1 or 2% is going to be different for everybody else. All right. So 1 or 2% of the account is just a general theme on how to manage your risk and not risk this much a day. That all sounds good. But when you get your hands dirty, it becomes different to think through that. Because why? Because you're drunk with emotion. Try to do a good job when you're drunk. It's going to be tougher. So you have to get good at understanding that, have a plan and have some things that aren't going to surprise you because you're going to react better to it. I'm walking down the street and I don't know a guy's going to jump out at me. I'm going to react poorly. If I could have a little bit of an expectation that there's monsters around a couple corners, I could react better. Monsters around the corner in that story are losing trades. Don't be surprised when you're wrong and when you have losers. And start doing what you say you're going to do. Taking trades outside your strategy are killers. Have a good weekend, guys. Stay safe.